All right, to decode what's next for the U.S. markets, we're now joined by Thierry Wizman, financial markets economist at the Macquarie Group. Thank you very much for joining us, Thierry. We've seen a strong rebound in U.S. markets, but will this sustain?
Look, I think it will sustain if we get more progress with regard to deal making in the realm of international trade. This is not inconceivable, of course. We've already seen a few deals happen. We've seen the deal that the U.S. has done with the U.K. Last week, we saw completion, effectively, of the contours of the deal that the U.S. has done with China. Yes, it's true that July 9th stands out as a critical date because that is 90 days past the period of reprieve that President Trump gave us in April. But nonetheless, as I keep saying, I do think that it's possible that that date will be extended as long as all parties are negotiating in good faith. And as long as the market seems to think that the worst case situations coming out of the Liberation Day reciprocal tariffs are not going to prevail, and that we will see de minimis reciprocal tariffs on at least most of the U.S.'s trade partners, I do think that stocks can continue to rally. One of the reasons that stocks in the U.S. can continue to rally is because the dollar is weak and has stayed weak despite the rally in stocks and the rally in other risky assets over the past 2 months. The fact that the U.S. dollar is weak is going to help operating margins for many of the companies in the U.S. indexes that sell product abroad, including the technology companies. And I think this is one part or one aspect of the oxygen that the market is benefiting from right now.
Right. How do you see the U.S. dollar depreciation over a long term? How should investors see it?
Well, this is all going to depend ultimately on a few things, but I think the most paramount things are first, that the U.S. dollar is expensive from a broad, long-term historical perspective. It may be as much as 30% overvalued in real terms still. That's the first thing. So the other thing, of course, is that investors themselves, foreign investors, global asset allocators, are probably overweight not just the dollar, but U.S. assets as well. And so to the extent that they recognize that the dollar is expensive, to the extent that they recognize that U.S. assets are currently much richer than assets abroad, we will see a rotation over time out of the U.S. dollar and into foreign assets as part of a broad rebalancing. This will happen on the part of private investors. Of course, it could also happen on the part of international reserve managers. But as this happens, and presumably takes place over the next few years, you will see the dollar decline. It can decline relative to the Canadian dollar. It can decline relative to the euro, to the Japanese yen, to the Korean won, even against some of the more less important currencies like the Norwegian krone. But we do see this as a general trend. We've seen over history that when the U.S. enters a depreciating trend, these are multi-year events. They don't last for a matter of weeks. They last for a matter of years.
Right. I'd also like to ask you about the possibility of a rate cut. The sentiment is high in terms of the commentary by the Fed. There is now a sentiment which says that there is at least a 20.7% chance of a rate cut in July compared to 14.5% earlier. In your analysis and reading of the market, what are the scenarios that you're factoring in?
Well, I'm factoring in really just two things. First of all, is the Fed going to feel comfortable that it has gotten enough data on U.S. inflation to reflect the impact or the impulse coming from tariffs? Of course, if they deduce that that impulse or that impact is small and not durable, they may very well decide to cut. The other thing that is prevailing on the Fed is just the direction of the economy generally in the U.S. Is it strong or is it weak? I tend to view it as weakening. Certainly, we've gotten a lot of forward indicators of the labor market that suggest that we are seeing a weakening there, slower hiring, lower quit rates, and intentions to hire weakening as well. So is this all going to prevail on the Fed in a way that's going to make them cut in July? I don't think so. It's probably still early. We still probably will not have seen enough evidence of whether or not tariffs are affecting inflation. But certainly by September, based on what Chair Jay Powell has already said, we may have seen a lot more evidence that will allow the Fed to move if in fact the direction is to cut. So I think it's more of a September event, not a July event. It doesn't mean that it will be followed by several rate cuts. It may be followed by only one more this year, but certainly September feels like the focal point or the focal time and place where the Fed will be willing to cut again if the data is conducive to that.
What impact do you think the big, beautiful tax bill is going to have on the market sentiment, considering it's going to add $3.3 trillion in U.S. deficit over the next decade?
Well, look, there's already quite a lot of dejection in the U.S. around the direction of fiscal policy in the U.S. and what it implies for the debt to GDP ratio and the prospect that we're going to see deficits as a share of GDP around 5% indefinitely. The mood in that regard is already bad. The mood in that regard has already subsumed the prospect that it's going to be very difficult to get out of this debt and deficit trap unless we find ways to grow the economy aggressively, because certainly Congress, through tax policy and through spending policy, is not pulling their weight to try to get the deficit down and to get the debt to GDP ratio stabilized. So right now, the market is still counting on growth to bail out the U.S. from its debt problem. Is that going to happen? Look, there are some signs that productivity is increasing, certainly by way of the technologies that are being introduced into the U.S. I think right now the market is still holding out hope that productivity gains and growth will bail out the U.S. and the U.S. will not have to resort on inflation to effectively reduce the debt burden.
Right. If I were to ask you, how broad-based is this rally across companies in the United States? Is it limited to a certain kind or a certain section of the companies? Do you see this broad-based? Because what we also hear is that the uncertainty is impacting the capex plans of companies in the United States. So does this stock market rally mirror the sentiment, the investor sentiment within these companies?
That's a great point. Remember, earlier I alluded to some of the forward indicators of the labor market suggesting that companies are less willing to hire on a forward basis. You're exactly right to point out other survey evidence, or survey-based evidence, like companies' willingness to invest. That has been weak too. But we think that has been weak in part because of all of the policy uncertainty around the U.S., whereas in the case of hiring and employment, it has a lot more to do with technological innovation and prospectively also a weak consumer putting somewhat downward pressure on firms that sell to the U.S. consumer. So there are really two different things happening here. Having said that, you're absolutely right in pointing out that the stock market seems to be moving in a direction that's at variance to the sentiment, including the sentiment of the large company, of executives at large companies in the U.S. The mood in the U.S. among businesses and consumers is a lot worse than one would infer if one only was looking at the stock market.
Right. And finally, any cues that you would be watching out for, apart from the jobs data, the payroll data?
Well, I certainly want to see if there's progress on these trade talks. Now, I know that there's a possibility we may not see any, and at the same time, it won't be registering as bad news because we'll get extensions or further waivers or an extension of the negotiating periods from the U.S. administration. That's certainly something I'm watching. Again, the critical date is July 9th. I think as we approach that date, there may be some market nervousness if we don't see the culmination or the conclusion of some of these trade deals. The other thing I'm watching, of course, is the signal that the Fed is going to issue at its next meeting as well. Are we going to get confirmation from the FOMC that the Fed is moving towards incrementally towards a rate cut? I think that we already saw that, by the way. I think we already saw that implicitly in the last Fed decision with the dots and with the presser that Jay Powell issued after the decision. But we want to see a little bit more incrementally in July that they're moving towards the rate cuts. We'll be watching that as well.
All right, Thierry, thank you so much for joining us. We appreciate the fact that you joined us and gave us a roundup of the U.S. markets and what you're expecting in the days to come.
My pleasure.
Let's move on. A trade deal